Angel is brought to you by NetSuite from Oracle, the only system you need to run your business. Go to netsuite.com/angel to get your free guide called Crushing the 5 Barriers to Growth.
Hey everybody, welcome to another episode of Angel. I am your host, Jason Calacanis, the author of Angel, the book about angel investing and early stage investing. When we talk about early stage investing and angel investing on this podcast, which you can reach at angelpodcast.com, and thanks for Spotify for including us in their new podcasting efforts. You can just search for Angel on iTunes and Spotify now and find us. In this context, the type of investing we're talking about is in high growth startups in the technology space, not angel investing in your brother's pizzeria, your sister or your cousin's movie, a dry cleaner. People will also conflate angel investing with that. How are they different? Well, when you're investing in a movie or your friend's album, you're doing it largely out of enthusiasm and affiliation for that individual, and you want to see them succeed, and less so for return. On this podcast, we're talking about angel investing in the context of getting a return and hopefully having the chance at a 50 or 100 or a 200x return. Now, these things sound fantastical, but it happens all the time here in Silicon Valley and in the Bay Area. And today on the program, I've got Satya Patel. I got that right?
You did.
I got it right, Satya Patel, who is the co-founder of Homebrew, which is an early stage, seed stage investment firm that founded not long ago.
2013.
I was about to say 5 years ago.
Yeah.
4 or 5 years ago.
Exactly 5 years ago.
And your co-founder is Hunter Walk. Of Twitter fame. He's big on the Twitter.
Yes, he is.
Very popular on the Twitter. And you've been investing for how long?
My very first professional investing job was in 1997.
Huh.
So for a very long time. But
what were you investing in then?
Internet companies.
Wow.
Yeah, software companies, internet companies.
Who were you investing in 1997? Who were you investing on behalf of in 1997?
I was working at a fund that was based out of New York called Geo Capital Partners.
Huh.
It was a fund started in 1983. It's one of the very first venture capital firms. And so we invested at that time in companies that you may remember, Jason, from back then.
Yeah.
AutoWeb, Home Store, Catalina Marketing, a bunch of companies like that.
The dot-com era companies.
The dot-com era companies.
And today we're sitting here in 2017, on the cusp of 2018. I'm not sure when this will actually be released. And it is fascinating. We see a huge bubble right now occurring that is, I think, analogous to the dot-com bubble in many ways, which is cryptocurrency. Everybody's talking about this as an investment vehicle and something that might interfere with what you and I do for a living, which is early stage investing.
Right.
Broad strokes, what do you think of the crypto bubble? Do you think it is, in fact, a bubble? How does it compare to the dot-com bubble? And is it an existential risk and an existential threat to early-stage investors like us?
This is a topic we could talk about for a long time, I think.
Yeah, so take whichever part of that question you love most.
So I'm not sure that cryptocurrency is a bubble because the value of cryptocurrency today is as a store of value.
Right.
But the opportunity is for it to be a mechanism for handling transactions and enabling commerce. And if it's able to do that, there are a lot of things that stand between that today and that happening. But if it's able to do that, then I think the current value is undervaluing the opportunity. If it remains a store of value, then is it a bubble, or does it still have value commensurate with what the market caps of Bitcoin and Ethereum and Litecoin and the others are today? I still think potentially. So
potentially.
Yeah. It's only a bubble in the sense that a lot of people who know absolutely nothing about it are putting money there.
That's the thing I find bubbly. I agree with you, because if you look at the people who were first involved in crypto, they were believers in the underlying technology. They wanted to see it manifest itself in the world. And in some cases, they were people who didn't believe in the nation state.
Right.
And
hackers and hobbyists and libertarians and those kinds of folks, not the mainstream American consumer.
And today we're seeing people, whether you're in an Uber or at Thanksgiving, people who have no understanding of the underlying technology or how it got to here, saying, how do I 10x my money? How do I 50x my
Yeah,
money?
the fact that Coinbase has more accounts than Charles Schwab should be scary to all of us.
And the fact that this was supposed to be a distributed currency, and Coinbase has now become the central bank.
Right. It is the trusted third party for holding your cryptocurrency, when the whole point of Bitcoin in particular and other cryptocurrencies is to be decentralized and not controlled by a central group.
You can put them into a drawer on a thumb drive with a password, which is the best way to store it.
Yep.
Putting it up on Coinbase, you expose yourself to the world's hackers being able to get into your account.
Yeah, but having your own crypto key and your own, USB dongle to hold your key is not something that the mainstream consumer, the average consumer, is going to do or understand.
Where do you think this ends? Do you think it crashes? Or do you think we go 10x from here? I mean, this is like the question of the day.
Yeah. People
specifically with Bitcoin, which is the sort of the height of this.
I'm much more bullish long term on Ethereum because it enables it can be programmed effectively, and so it allows a lot more to happen. And there are arguments that it could be more scalable as well. Bitcoin as a store of value, I think, will continue to hold some value. Whether Bitcoin becomes the currency through which commerce happens, I think, is an open question.
And this is the thing that I think people are very confused about is, am I buying a store of value? In other words, an ounce of gold that I can then go sell at some point for some amount relative to what I paid for it, slightly up, slightly down, double, triple, up or down. Or is it something that I'm going to use to buy coffee with or my next home? And that latter part, it turns out Bitcoin isn't exactly well suited for that. It takes a long time to clear a transaction.
Mm-hmm.
It's not instant.
Yep.
And the fees are actually becoming expensive.
Yeah, you touched on a couple of important problems. Security is another problem. Stability of the currency is another problem. So there are a whole host of things that have to happen before Bitcoin is used for commerce in any mainstream way.
So now let's move on to the next piece of this puzzle, which is you and I do early stage investing. Mm-hmm. We evaluate companies and founders for a living.
Right.
This is what we do at its core, I believe, and you can tell me if you disagree. And we see a whole nother alternative universe emerge over the last 2 years. You and I do this. We meet with the same founders over and again. We refer people to each other. We try to evaluate them. We look at what they've built. We look at their history, look at their teams. We look at the metrics. We roll our sleeves up. And then we see right next door this bizarre world where ICOs are happening, internet initial coin offerings, where people write a white paper and they then get a bunch of crypto, Bitcoin, Ethereum sent to their account. And all of a sudden they have $20 million where we would have put in $2 million or $250,000 or $25,000 on a white paper. What are your thoughts on this ICO boom that's occurred over the last, I think it's only been really a year of...
Yeah, year and a half, year
and a half, really. What are your thoughts on this ICO? And this is where people are claiming the slowdown in angel investing and early stage, seed stage investing is causing the ICO, or the ICO are causing the slowdown here. We'll get into that in a minute, but what do you think of this parallel universe? Do you participate in it? Do you look there for deal flow?
No, I saw some data that said the volume of ICO dollars this year was equivalent to 6% of all venture dollars.
Which is significant or not significant?
That's significant.
It's significant, I would say.
Year one.
Year one is
incredibly
very
significant. Yeah. I'm not sure it's going to be 6% next year. Because I think it's been a lot of greater fool activity in theory that's been playing out this year.
Yeah.
And next year, I think the bar for a quality white paper and the bar for who will potentially have access to these ICOs is going to change pretty dramatically. To your question, I think our business is predicated on two things. It's picking the right teams, founders, and ideas to back, and then it's helping them along the way. And so do I believe that capital and counsel will be disparate things over the course of time? I do believe that, actually.
Explain that a bit.
Yeah. So can you envision a world in which if you look at a cap table, you can see people whose names are there because they contribute counsel and advice versus names that contribute capital?
Got it.
I think that's a world that can exist. It exists in small forms today, right? You have advisors to the company who aren't necessarily investors, and you've got people who invest. And historically, it's been the case that in order to access counsel, you had to accept capital. Or if you wanted to provide counsel, you had to contribute capital. And I think that at least we can envision a world where capital and counsel get valued separately. Are ICOs going to be the mechanism that drive that? I'm not sure about that.
Right.
If you pay attention to kind of our VC brethren, they're investing in ICOs before the ICO happens, right? They're getting the early discount.
Which is crazy.
Right.
Who ever heard of such a thing? I'm getting emails from people who are founders that I considered investing in 10 years ago, 5 years ago, and they're saying, Jason, have I got a deal for you?
Right.
And when I hear, have I got a deal for you from a founder, I'm kind of like, wait a second. What is this? The Price is Right?
When did we see this last time? It was in the bubble, right? When people gave friends and family pre-IPO shares.
You're right.
Right? Do you remember that?
Yes. I participated in it a couple of times.
We all benefited
doubled
from it,
and tripled my money.
So I think you've seen that here as well.
Wow.
It
feels unethical to offer one group of people a security at a 50% discount and then shortly thereafter trade on their names in order to sell to a group of people who do not have the name recognition at double the price.
Yeah,
it seems to me to be...
I won't comment on any particular project,
right?
But I will say that most of these ICOs are structured in a way that benefit the writers of the white paper at the expense of everybody else.
Yeah, unbelievably so. We had Tezos on This Week in Startups recently, and they were taking down some double-digit percentage of the total amount as a commission for services rendered. Now, when I had her on the program, I was trying to get my head around this, and I was like, well, she's like, well, we did a lot of work. And I just thought about it. Well, I have a lot of founders who come to me and do 2 years of work, and then we invest and we give them $500,000 for 10% of the company. Mm-hmm. But that doesn't mean that they should take the $500,000 as a reward for the last 24 months of effort. It's the $500,000 to go forward looking to see if we can really build something.
Yeah, it's some of these authors are effectively doing a secondary before they've even written a line of code.
That's an interesting way to look at it. They're literally doing a secondary offering for shares before. And this also had an analogous moment in the dot-com era, which was people launched incubators and took them public, I believe.
Right.
I'm trying to remember the names, but I know there was CMGI, there was Idea Lab, VerticalNet,
ICG maybe.
ICG. Yeah. And I'm not sure who did this, but one of them did the most outlandish thing ever, which was like they were going public based on their ideas. It'd be like you and I be like, let's make public our ability to invest in companies.
Right.
And then you give us a bunch of money, we sell our shares into that, and then we go.
Well, we know how that ended, and this man similarly.
So when you look at and so I see our retreat next year, or maybe it's flat, makes sense, and then the bar will go higher.
Yeah.
Have you ever
the market will regulate itself?
I think it has to, right?
Yeah.
But there are these pools. The one thing that I am confounded about, which is a lot of these do not allow American investors, which means one of two things is happening, or perhaps both of these two things. But one scenario is Americans are, in fact, not participating. There's so much global cryptocurrency wealth and such pent-up demand to get into startups in qualified places like the Bay Area that they can't get into, that they're just enthusiastic, want to do it. Or Americans are participating as well and just using wallets that maybe are geocoded outside the U.S.
I don't know about the latter. The former is certainly happening.
Pools of capital.
Pools of capital.
Who can't get into the Bay Area.
Globally, people are chasing yield. Right?
Yeah.
There's no yield anywhere except in private investing for the most part.
Right. What we do.
Yeah. And if you don't have access to what we do, then ICOs seem like a really attractive thing to get involved with. If you've got pools of capital to put to work.
Of the ICOs that we've seen, you and I would perhaps have invested in one of 200 of them.
Right.
In other words, it's like people think they're investing in the actual pool that we would invest in Fission. It's like, no, there's like one, like Vinny Lingham doing Civic is like, that's a legitimate person. Like, but everybody else has got no track record and no skill in some cases. They're just white papers. I never understood investing in a white paper.
And in most cases, kind of the rationale for issuing a coin or leveraging the blockchain or leveraging a cryptocurrency is specious at best, right? So I think that's going to be a big change in 2018.
When you see people say, we take the coin and we're going to put a coin on Uber, we're going to put a coin on Airbnb, we're going to put a coin on YouTube. What do you think?
Why?
Any of those make sense? Yeah.
Why?
Yeah.
What does the coin enable that isn't possible today? And how does that benefit the holder of the coin?
Huh. Yeah, that's the thing. And the SEC now is looking at this issue, which I guess they call utility tokens, versus selling a
security.
Selling a security triggers all kinds of regulation. Selling a token at Chuck E. Cheese triggers nothing. And the SEC now is realizing, or coming down and looking at these on an individual basis and saying, nah, this was a security. And I was talking to a young founder and said, what's the worst that can happen? I said, I like the way you phrased that question. The worst that can happen is you can go to jail, or you can pay a huge fine,
right?
Or you can get banned from the securities industry for life.
That's right.
And you could have to hire an attorney for 5 years to defend you for $250,000 a year. And never know if you're off the hook or not, because the SEC is under no obligation to tell you if you're in the clear or not.
Somebody asked me a similar question, which is, what's the downside of doing an ICO if the whole point is just to put money in your pocket? And I said, well, you could do that, but then you'll have 5,000, 10,000, 20,000 people who bought your coin, who for the rest of your life will chase you around the interwebs, making your life a living hell.
What is the harm in taking all the money from a register that was left open? The register was left open.
Right.
I mean, what does it matter? It's like, it's amazing to me how people, when you slap new technology onto something, can just lose their judgment. The judgment here is pretty easy. If you take people's money and their expectation is a return, and in fact, their expectation is a great return, a giant
enormous return,
an enormous return, for you to then turn around and say, no, it's actually a token because I said it's a token. But then I'm marketing it. I saw this dipshit, Jubarish Chahal, the guy who beat up a woman.
Oh, okay.
The guy here, Radium One or something. Radium One. Anyway, he's doing an ICO. And I was just like, oh my God. And he's doing it with Paris Hilton or something, was his PR person for it, or marketing for it. And I was like, is this not a red flag for people? How many red flags can you fly above this offering to say, stay away? Let's talk a little bit about how you evaluate founders, because I'm giving you a scenario of how you would just run for the hills. But when you meet people, I see a lot of people now trying to optimize for being what early stage investors, seed stage investors are looking for. But what, in all honesty, do you try to know about a person?
Sure. I think at the end of the day, we're trying to figure out three things. One, why is this person uniquely qualified to do what they're doing? Two, is this somebody that will be proud to put sweat and reputation behind? And three, what about this opportunity is consistent with the work or the problems that they've tried to solve in the past? Meaning, what's the why behind what they're doing? And those are the things that we're most focused on trying to ascertain through, our diligence process and our relationship building.
Are there things that when you see somebody doing them, it's pretty easy to eliminate them from this thesis? Yeah. What are the ideas that are easy to eliminate? Or I'm sure say the founders who are easy to eliminate from this lineup.
Yeah, I mean, we talk often about backing missionary founders instead of mercenary founders. And
What's the difference?
The difference is, for us, a missionary founder is somebody who's trying to solve a problem that is almost personal in nature to them, right? Solving the problem is almost more important than building a business around it. But they care deeply and passionately about solving that problem. A mercenary is somebody who identifies a market opportunity and figures out that there's a way to create value by addressing it.
Got it.
That's not to say great businesses can't be built by mercenaries. Many have.
Yeah.
But in terms of where we focus and the type of people we want to work with, they tend to fall in the missionary category.
More often than not, correct me if I'm wrong, the missionary will not give up, where the mercenary will move on to the next bigger opportunity.
We certainly believe that. We think that they're going to be better at withstanding the ups and downs of startups. They're going to be better at recruiting people to the mission. We believe that they're going to be better at selling and evangelizing to customers. We think the probability of success increases with a missionary founder.
Yeah, I have. And what do you think inside of a company? So you invest in a missionary founder, and your missionary founder says, I found the most amazing sales executive.
Mm-hmm.
She's extraordinary, but she simply wants to make the maximum amount of money, and it's clear she's a mercenary.
Mm-hmm.
What's your advice? Hire them and have this incredibly deft person, just maraud through the industry and get massive revenue into this enterprise company if it was enterprise software? Or do you say, you know what, you really want somebody who, although they might not be as aggressive or might not have the short-term returns, go for the long-term missionary?
Yeah, we kind of use all these heuristics or mental models, and another one of them is aptitude is necessary but not sufficient. Attitude matters a lot. And so for us, alignment with the mission and the values of the company is as important as the skills of the particular individual. And for the same reason, we think missionary founders are going to be more successful. We think people who buy into the mission and values of a company are going to be more successful over the longer run.
It does seem that way, doesn't it? Like if you're a mercenary, you leave so quickly. I find the mercenaries, they leave in month 18 or something, or month 15, and you're like, wow, if they had just stuck with it.
Yeah.
Can you imagine the impact they would have had?
If you put a mercenary in a leadership position, you tend to draw more mercenaries into the organization.
Right.
And that's how you then poison the well, so to speak, for the entire company.
Which is brutal.
Yeah. Hard to recover from. It's hard to change the DNA of a company once it gets established.
Which the DNA, some people would refer to as the culture, I guess, is synonymous with this. What do you think the keys are to setting a good culture? What do you think? Is there a specific good culture, or is it just having a culture?
I think it's being intentional about developing a culture.
Yeah.
And doing that within the first 25 employees. I think after you get past that stage, it's really hard to change the culture of a company. And ultimately, the culture flows from the founders and the early employees of the company. So if that group is intentional about defining the culture in a way that helps companies make decisions about who to hire, about the business, about the product, then you're going to be better off over the long term, irrespective of what the definition of the culture is.
What should a founder do? What would be your advice to them if they were just running on adrenaline for the first year or two, and they look up and they got 20 people, and they never read a book on culture? They didn't read Tony Hsieh's book, and they never even thought about culture.
Yeah.
What do they do then? Because now there is some culture there. They just don't know what it is.
Right.
Is there a way to identify it and clean it up or tweak it? Or
yeah, I think there are ways of.
Have you seen that?
Yeah, we've seen that for sure. Sometimes you're just running hard, right?
Yeah.
And culture is always on the bottom of the list in terms of things to do because you're busy building stuff and selling stuff.
Yeah.
So I think there are ways to kind of harness the feelings and the values and the experience of everyone in the company at that stage and say, well, if we took a moment and step back, what's the language we would use to define the culture? And figure out where those similarities and differences are to then articulate what the culture truly is, and then see if that's what you aspire to be or not. If it's not, at that stage, you can still make adjustments to it on the edge.
Right. But it could be a little painful extracting some culture killers from the,
the organization is still small enough where you can extract that DNA.
Yeah.
Right. When you're 50, 100 people, you can't fire half the company generally.
No. I've had to sit down with people and have the discussion and just say, you know what? I know you're doing pretty well here, but I don't think you're a culture fit. Like the way you operate is just not in line with working well with others or whatever it happens to be.
Mm-hmm.
I wonder if this is the right place for you. And almost universally, when I phrase it like that, like, I wonder if there's a better opportunity out there for you. They're like, yeah, I've been looking.
Yeah.
It's like almost all the time.
I think almost any time you kind of have to let someone go or fire them, it ends up being a relief for them.
Yeah.
And it ends up being generally a positive thing for them because what you're doing is you've kind of decided like they can't be successful here, which is on you as much as it is on them, right? Because you hired them in the first place.
Right.
And for whatever reason, you thought that the system and structure you had put in place would help this person be successful, and it turned out not to be, right? They probably weren't unskilled or, the type of people that you would have run away from because you hired them.
Yeah.
So it's as much your fault as their fault. And if you're willing to admit that and have that conversation with somebody, then oftentimes you'll find that it's a relief for them to kind of be let off the hook, so to speak.
Yeah. It's like, You see sometimes when people get divorced too, like
Sure.
it's brutal that first year. They have PTSD sometimes, but then they sort of work their way out of it. And like, oh, then they become friends with their ex
Yeah.
partner and everything's copacetic.
Right.
And they're this great relief for everybody who had to sit through dinner
Yeah.
with them
Right.
while they're fighting. And you're
Yeah.
like, we're all here having dinner. Like, can you just too cool it?
Yeah, I'm sure you, like us, have friends who've gotten divorced who have kids,
Yeah.
and they stay together because of the kids, and then they decide to get divorced. And while it's difficult for the children, oftentimes the kids are also relieved because they're not at that dinner table anymore where they're
Right.
hearing the yelling and screaming.
Yeah, it's crazy.
Yeah.
Hey, when we get back from this quick break, I want to talk to you about how you decide to keep funding or not follow on investing in a startup after you've already invested in it. In other words, if you lose religion, if you lose
Sure.
your faith, when we get back on Angel, the podcast. Hey, everybody, let me take a moment to thank my friends at NetSuite by Oracle. Yes, the results are in, and Survey Inc.'s 5,000 company survey shows that the top barriers to growth are finance takes too long to close the books. That's number one. Number two, your company is too slow to launch new products. Number three, hiring and keeping good people. Number four, managing cash. And number five, too many disparate, disconnected systems. So it's hard for founders and management teams to get a full picture of their business. It sounds like all of these companies are outgrowing their business and financial management systems, doesn't it? Well, QuickBooks and spreadsheets, they can only get you so far. They're great at the start, but it's now taking you 2 or 3 times as much effort to get this basic reporting. And you cannot get accurate answers to your questions as a management team. Does this sound familiar? It does to me. And that makes it impossible for you to make strategy decisions going forward. You should know that the number one system for growing your company is NetSuite from Oracle. Yes, that's right. NetSuite from Oracle is the one system, the one singular system that will track and manage revenue, cash flow, HR, inventory, and even your projects, even e-commerce for every single industry. That's why NetSuite is so powerful. You can run your business from a dashboard even on your phone. And you need that dashboard so you can make those critical decisions as the business leader. It's never too early to invest in NetSuite and to start using the professional grade business management systems that they provide. So go to netsuite.com/angel, netsuite.com/angel, and get your free guide called Crushing the 5 Barriers to Growth. That's netsuite.com/angel, netsuite.com/angel. It's the only system that you need to run your business. Get that free guide, Crushing the 5 Barriers to Growth, at netsuite.com/angel. Thanks again to NetSuite for supporting season 2 of Angel. Okay, let's get back to this amazing discussion. Welcome back to Angel, the podcast. You can visit us, angelpodcast.com. We're also on the YouTube and the SoundCloud and Spotify, iTunes, all those places. If you love this podcast, please go ahead and take a moment to write a review on iTunes or whatever podcast player you're looking at. That really helps us. Rate and review. I hate to pander. And hey, listen, buy the book, read the book, and write a review of that as well. It makes me feel great. And I'm thinking about writing another book because I got so many good reviews.
What are you going to write it on?
Well, this was from this perspective of an angel investor and like what I learned in 150 investments. But founders have been reading it to sort of unpack the other side of the table.
Yeah.
So I'm thinking about maybe going back to where I was on the other side of the table and what it takes to be a great founder. And something about maybe for younger people who are thinking about being a founder. So I'm kind of torn between those two, but having all the war stories, you talked before about disconnecting capital from experience or advice. It's once you get past a certain number of investments, I don't know when it happened for you, you kind of feel like, I understand how chess works now. You know, like I can play poker at any poker table with the best players in the world. I may not win,
right?
But I don't feel I'm out of my element. I've seen enough. When did that happen for you that you felt like you saw enough movies play out that you kind of like, I understand how startups work?
That's a good question.
Do you feel like you understand how startups work now after doing 80 plus investments?
I feel like I have a base understanding of how startups work, but startups are one of those things where you're always learning.
You are.
Yeah. And that's why I love what we do.
Yeah.
But
what did you learn this year? I'm curious if this. I mean, you look back on it and you're like, God, you know what? I know more of this. I've got to know more of this. I have my own. I'll tell you mine after. Or I'll tell you mine what you think.
Yeah. Tell me yours.
The one I'm struggling with is being less surly when things go bad.
Mhm.
I have an aversion to when people do things wrong,
Mhm.
in a sense that they didn't put their best effort in. And when I see companies fail, sometimes in the failure, I see people just not protect their investors or not do the right thing. And I'm trying to reconcile this in my brain where like they're like, can you sign off on this exit? And I'm like, the exit promises the investors nothing.
Mhm.
But it says here it's a $2.4 million deal.
Right.
So what are the investors getting? It sounds like 40 cents on the dollar, but you're saying there's nothing here. It's like, oh yeah, well, we're going to give $1 million to this person. We're going to give $1 million over here to pay down the debt. And then maybe we'll give something to the founders. And I'm just like, well, why would I sign off on this? And then people are like, well, you're supposed to sign off. And I'm like, why am I supposed to sign off on this?
So we're in the business of losing money, Jason. That's why.
I guess so. And that's what I've reconciled is like, if anybody should know that the wins make up for the losses,
Right.
it's me.
Yes.
But still.
Be a good actor.
What's that?
Be a good actor.
I'm trying to be.
Yeah.
I literally am like sitting there on some documents in my thing, and I'm just telling the person like, "Can I talk to the acquiring company?"
Mm-hmm.
Because, and I've done this before, where I talk to the acquiring company. I say, "You're buying the company, but you're kind of screwing the investors. Can we do a little better for the investors?" And here's how. And they have done it.
Yeah.
But in this case, the founder doesn't want me to talk to the acquiring company because he thinks it's going to screw up the acquisition. And I'm like, "But they're buying our shares. So shouldn't I get to talk to the person buying our shares? Like if I want to?" I don't know. What do you think of my conundrum there? I just have to grow up and be better.
Listen, we're
winner?
we're in the business of risk capital, right?
Yeah.
And you are backing a set of founders because you believed in them, and assuming you probably had some kind of affinity towards them, right?
I did,
you like them
yes.
as people.
Sure.
So if you were a good judge of character and you still like those people, and the outcome is one which is not great for you, but lets them move on to their next thing comfortably, like we should be supportive of that. Right? I mean, whether you get 50 cents on the dollar or a nickel on the dollar in that particular investment is going to make no difference.
No, that's not the part that I don't like. It's the part where I see everybody like pocketing all this money and then the investors get nothing.
Sure.
That to me rubs me the wrong way.
Yeah, if they approach it in bad faith, that's different.
I feel like a little bit of those bad faith ones. The ones where it's like, listen, I got nothing out of it. I'm the founder. I got nothing, but you guys all got 10 cents. And I'm like, yeah, let's do your next company. You know, like, and you could take a carve out for management.
Yeah.
But I don't know if you've been seeing this more and more, these like really fugazi deals where people are getting a bunch of equity in the company, you know, employee contracts.
You know, for better or worse, we feel great about the people that we've backed.
Yeah.
You know, whether they'll be successful as founders or not is a different question, but we feel very proud to be working with the people we work with. So that hasn't been an issue for us. In fact, we may have a slightly different but related issue is that we're not afraid of backing unconventional founders or founders who don't come from a Stanford CS background. And oftentimes those founders don't resonate as well with the upstream investor.
Yes.
And so one of the things that we've learned in this year, to get to your question, is that the founder's ability to sell to the upstream investor, independent of their background, is as important as virtually any other skill, especially in this fundraising environment, which is getting more and more difficult upstream.
Yeah.
So I'd say that's
when you
probably
say
a big
upstream,
lesson.
you kind of mean down. Some people might refer to it as downstream or upstream, but the later stage, the Series
correct.
A investor, Series B investor, because you're doing seed stage. That Series A now, seed stage is kind of what Series A used to be.
Yeah.
In terms of dollar amounts, we're putting $1.5 million, $2.5 million rounds.
Mm-hmm.
But to get that Series A is so hard.
Yeah, and the Bs are even tougher.
Bs are getting tougher.
Yeah.
Huh. What do you think it takes to clear market in a Series A investment today? Enterprise or consumer? Either one.
Roughly speaking, enterprise, I think to clear Series A, you've got to get north of $3 million in annual recurring revenue.
Just told this to somebody and they told me I was crazy. And I said, it was exactly the number I said. Because I remember 2 years ago, everybody was saying $1 million.
Yeah.
And then last year, people said 2. And then this year, I kind of got the sense it was 3.
Yeah. And for consumer, I think you've got to get north of 1 million monthly active users for sure.
Easily.
And growing 30% a month.
Right.
Yeah.
I think easily. I mean, I was going to say 5 million or something.
I mean,
because consumer is
you want
just
to be
so
safe, yes.
quixotic and weird, and you know, people And the other thing I'm finding, tell me if I'm wrong, is that people tend to, the later stage investors, the upstream, downstream, whatever we call them, Series A, Series B, big firms, they don't seem to have a sense of urgency to close deals. They feel like they can sit back and just wait and see what the fallout is.
Well, there's a bunch of reasons for that, I think. One is that most of these funds are sitting on enormous portfolios in a market where there's been limited liquidity, right? So they're not able to get off a bunch of boards.
Right.
Somewhere in that portfolio, there's a problem child or an entire family of children that are problems, right? And so
that are taking their energy?
That are taking their time and energy.
Yeah.
And so if they're going to write a check, they want to feel like it's going to be a no risk, no effort check. And
today, whereas they might have been like, I don't have anything going on here. I got to get something going.
Right.
In 2007, 2010, yeah, let's take some risk.
Yep. And then the other thing is all the funds have gotten large, so they're willing to wait and write a large check and overpay at the C or the D rather than take what they perceive as risk at the A or the B.
So where does that leave the market, do you think? Is this a intractable problem for founders, or are there ways to get through it, to weather the storm, as it were?
Yeah, I think the way to weather the storm over the next few years will be to think of the seed not as a stage but as a phase. Right, where it could be comprised of multiple small financings to get you to the level that you need to achieve in order to raise a Series A. Because you have to rise above the noise. What's that?
VC funding, in other words. Like taking the names out, it's really like there are seed stage and angels, and then there's VCs. And the VCs are the ones who are waiting and want to write bigger checks and have a more of a slam dunk, if you will.
Yeah.
De-risked investment.
Right.
Overpay for de-risked investments, I think is sort of a nice way to paraphrase what you're saying.
Yeah, I think that's right.
They overpay.
So I think you'll find that companies are going to have to raise more money during the seed phase in order to prove more, to rise above the noise, to be able to raise a Series A, because there continues to be more seed companies started and funded, I think, than ever before, despite what you see in some of the data. I think the data is influenced by the fact that a lot of these companies are raising on notes that don't get, filed and reported.
Right, in a database anywhere or in the SEC or anything.
Yeah.
So I think the number of deals could be much higher.
Yeah, I think it's as much as it's ever been, at least based on what we're seeing. And rising above the noise, given that population of seed companies, when the number of Series A checks being written hasn't changed that dramatically, is much, much harder.
Who's going to write these checks in this seed phase, as you call it? If we're moving to a seed phase and there's going to be 3 or 4 investments before Series A, let's say 4, who's going to write all these checks? Is it going to be me and you? But we have only a certain amount of time.
I think there's plenty of money out there, right? Whether it's angels, pre-seed funds, institutional seed funds, even some of the larger funds that are formalizing their seed programs, as you know. I don't think there's going to be any shortage of money at the seed stage.
Talk about that. This large funds doing their own seed stage stuff. We had Sequoia Scouts, which everybody knows that was the first one.
Right.
And
now they're raising a seed-focused fund.
Oh, are they?
Yeah.
I wouldn't know.
Yeah.
But they're doing a seed.
It's public information now.
It's public information now. And how will they formulate that, do you think? And what impact will that have?
Well, it sounds like they'll do as many seed deals in any particular year as they've done A's. So there's certainly a percentage of the very best deals that will be done by Sequoia, I imagine. Whether they're going to be good syndicate partners or try to hoard the entire round at that stage is TBD.
Right. Explain that dynamic of the hoarding of the rounds, because Sequoia famously, I believe, WhatsApp, they did multiple rounds of funding. They did internal rounds or inside rounds where they funded it all the way through
to their credit. Yeah,
to their credit. And the founders, I guess, that was easier for them to just keep going to the same investor and filling up the bank account.
Yeah.
Is that a good strategy, bad strategy? Is it good for the ecosystem, bad for the ecosystem? You sort of said it like, we'll see how that plays out. Do you think that there's a chance they could just take the entire $1.5 million rounds, $2 million rounds?
The way I'd answer that is say that we believe at the seed stage, there is value around having multiple helpful heads around the table. We also believe, given our concentrated strategy, that we have to have enough skin in the game in order to put our sweat and reputation behind a particular company. So we want to try to balance between having enough ownership and enough dollars at work with getting other like-minded and helpful investors around the table, which you can do now because the rounds have gotten large enough.
Yeah. What's the target ownership for you? 5-10%?
We tend to write checks between $500,000 and $1.5 million, and ownership ranges anywhere from 8 to 15%.
Got it. And if you own 8 to 15%, you have to roll up your sleeves for the next 7, 8, 9, 10 years. That feels good. But if you own 1 or 2%, be like, well, I'm putting all this effort in, and I'm only got 1 or 2% of the company. It's kind of a bummer.
Right, and we're only doing 6 to 8 investments a year, so we're better off allocating that capital elsewhere then.
Right. To put more of your effort and your cycles, your brain and your network behind the ones you have a bigger chunk of.
Right.
Fascinating. Before we went to the break, I asked you a question about follow-on funding.
Mm-hmm.
This seems to becoming a very prescient issue because of the Series A crunch and this sort of seed stage turning into a phase.
Mm-hmm.
How do you have the hard conversation with the founder that you're not going to continue investing? What is that like? If I come to you and I'm like, hey, listen, I deployed the $2 million in the seed round.
Yeah.
I feel like I figured it out. I'm like one pivot away from greatness, and you just don't believe me. How do you?
I guess the first thing is I'd like to believe that every set of founders that we work with knows at any moment in time exactly where we stand around our excitement about putting more capital to work.
Got it.
So that's the first thing is there should
How do you
never
communicate
be
that
a
to them?
surprise.
How do you communicate that to them?
Well, our model is to do that small number of investments and work really closely with the founders. So we have formal interactions with every company every week or every other week.
What is that, like a phone call, a chat?
Yeah, we refer to it as a stand-up. So it tends to be a 30-minute phone call or a video or a chat.
Really, with every single company?
Yeah.
Wow, do founders find that a little too much?
You'd have to ask them, but our internal surveys done by third party suggest that they find it pretty useful.
Oh, you did a survey by a third party to get their feedback on it?
Yeah, we did a whole 360 review cycle with our founders and our co-investors to figure out what we're doing well and what we're not.
Wow, that's kind of brave.
I don't know if it's brave. We benefited from that kind of feedback when we were on the operating side.
Got it.
And we think of Homebrew as our product. And so we wanted to do the same type of work there to figure out what.
So some outside consulting firm calls the people you work with and says, how are they doing?
Yeah.
What could they do better?
Yeah.
Where are they weak?
Mm-hmm.
Where did people feel you were weak? Did they feel you had a leak in your game, as it were?
We're very fortunate with the feedback that we got. There are definitely areas for improvement. One is because we have this hands-on model, there was some confusion among some founders initially around what they felt they could and couldn't ask us to do for them. Because they have expectations around how investors behave, and we tend to behave a little bit differently.
Right.
And
I would certainly say I've never heard of anybody doing a stand-up weekly or every other week with a company. That's a unique innovation for you.
And so we need to do a little bit better job with our onboarding process.
Of saying you're going to do this.
Yeah, to make sure that people are aware of what we will and won't do.
Got it.
So that's an example of some of the feedback we got.
Yeah, and I think that's an industry-wide issue as well, which is, you used to have VC firms, like the Benchmarks of the world, who they invest, you get a great partner, they give you advice, they're there for you, but they don't have a research or a marketing or a human capital department. And then you have Sequoia, which always had a human capital partner, but they didn't have a department doing HR recruiting. And then you have Andreessen and Horowitz come out and be like, yeah, by the way, come on in. This is your big, they bring them in to their offices, and they're like,
roadshow.
There's a roadshow. It's like, here's the marketing department who's going to help you spend your money with Facebook, and here's your, recruiting team that's going to hire your team. And you're like, well, what do I do as the founder? Yeah. What do you think of that? Is it too much sometimes? Like what Andreessen Horowitz does, is that like an overkill, or do you? It seems to me.
I think my honest answer would be, I don't know at that stage of investing.
Right.
At our stage, we think that there are relatively few things that the company needs to do. And most of them you want the company to learn how to do themselves.
Right.
So we also have a talent partner, but she doesn't operate like talent partners at the larger firms who are effectively internal recruiting agencies.
Yeah.
She is more coach than player.
So
she is helping these startups put in place recruiting process, think about compensation, think about performance management, and effectively teaching them how to fish.
Got it.
So that's a very different role, and we think more appropriate at the seed stage than trying to be a surrogate And
Yeah.
Hunter uses this analogy, which I laugh at every time. It's like putting a baby in an exoskeleton and giving that baby the ability to lift cars, but then at some point taking the exoskeleton away.
It's a baby.
And then you've got a flabby baby that can't lift anything.
Right.
Right. And so we try to approach it in a different way.
I have to agree with your approach. And I went through a similar thing where I was obsessed with just getting a monthly email update because I would, and it wasn't because of some desire to, be micromanaging. It was out of a desire to be helpful. And the frustration of companies failing that I felt I could have helped and them coming to me too late. And so I said, just put in the first line of the email,
what you want help with,
what you need help with, how many months of runway you have, when the next fundraiser is, whatever the most pressing things up top and whatever the most superfluous things at the bottom. So if you got a speaking gig at TEDx in Albuquerque, that could be the last thing.
Right.
And if you got a speaking gig at TED in Vancouver on the main stage, that could be the second to last thing.
Yeah.
But your revenue and your customers could go up top. And I got pushback from like maybe 5% of founders. I don't want to do this. And I was like, are you tracking the core metrics of your business? Yes. I'm like, what are they? They told me on the top of their head. I'm like, and then one or two maybe didn't even know their metrics. I'm like, well, if you don't know your metrics off the top of your head, it's kind of your job. So can I help you get the tools together so you actually have a dashboard of your own business? Because this is a leak in your game as founder. You need to know what your Google Analytics say and your customers.
That's for us the beauty of the stand-up model, because the agenda is owned by the founders. And so as a result, we know exactly what's top of mind for them. What's the pressing issue of the day?
Yeah.
And then we also know as a result what they're not focused on. So hopefully we can help them see around some corners and avoid some problems that we've seen in the past.
Yeah.
So that tends to be a pretty tactical discussion. And then we use the board meetings, because we create a board at the seed stage too, to focus, take a step back and focus on the strategic issues.
Got it. So there's tactical and strategic.
Yeah.
Board meetings, strategic. Stand-ups, tactical. Blocking and tackling in the,
Right. What's the hair on fire problem that you're dealing with, and can you help? How can we help put it out?
Right. And board meeting, hey, what is this business going to look like in 3 years?
Yeah. What milestones are you focused on? What risks are you going to eliminate or reduce before the next financing? All those kinds of things.
Let's talk about board meetings.
Yeah.
Big focus over the last couple of years. I'll say even this last boom cycle, right? We're in year 10 of a bull market and a bull cycle, which I think startups have been parallel to a certain extent with the stock market. And people said, governance, wait. But you're saying the opposite. Governance now.
We're not saying governance now, because from our point of view, the board meeting isn't about governance.
Okay, so people did say no board meetings.
Yes.
Now no boards, and you're saying board. So
yes, and
explain to me the difference.
Almost in all cases, the board at the seed stage is 2 founders and 1 of us. So it's not about governance, right? They still have complete board control and voting control.
So that makes sense.
Right. So what we're trying to do, in the same way that you want to build kind of infrastructure and process for your operating company to scale, we're thinking about how do you build muscle memory around managing your board and building your board and leveraging your board, so that when a Series A investor comes around and writes a $5 to $15 million check, that's not the first time you're having a board meeting.
Yeah, it's the 8th.
Right? And there's a model of running your board meeting which transitions to the Series A board member, as opposed to the Series A board member kind of saying, well, this is how things should be done, and trying to mix it all up. Right. So,
that's a fascinating one.
So one is building muscle memory and getting practice. 2 is having designated time where you step away from the tactical to focus on the strategic. Right. And then 3 is, from our standpoint, it sends an important signal to the next investor that somebody's been watching over this company.
Right.
Right. This is not just a company that's been operating willy-nilly. There's a professional investor who has been looking over it. And so when we make an introduction to a Series A or Series B investor, they take it seriously.
It's so interesting that we're simpatico on this issue, because we're kind of the lone voices in the wilderness on this.
Yeah.
I, too, have done this with my founders, and my founders love it. And in fact, in my documents, a couple of years ago, along with information rights and doing a monthly update, I put that in my side letter.
Interesting.
right? Interesting.
Yeah.
And then I also put in the side letter, if we represent over 5% of the company, we have a board seat in perpetuity.
Oh, wow. Okay. That's different than us.
And it's super different.
Yeah.
And I just thought, let's just make it so we have the option to do it.
Mm-hmm.
And the founder says, oh, so we have board meetings? That's awesome. And people think the founders don't want to have board meetings. They do. They want to spend time with their investors. It's fun.
Yeah.
It's fun to help build
And
these
we're at
businesses.
the point now where if any founder has a question about either the stand-up model or the board meeting, we have a whole family of founders who will talk to them now and tell them why it's been so great for them. So we're big
more
believers in it.
discipline and more support. It's like going to a personal trainer or having a dietitian. Like, if you're trying to lose weight, do you think and get stronger? Do you think a trainer and a dietitian are going to be negative value? No.
Right.
This is going to be.
And if you've done the work of choosing the right investor for you, right, and diligencing that investor in the way that they've diligenced you, then you should feel perfectly comfortable having them on the board and having that level of dialogue with them.
Yeah. I find for me, having my board meeting for inside.com with Ruloff, it sets a, the 6 time a year marker of like, hey, we really need to perform.
Yeah. And I imagine you get something valuable out of that, an investor like that every single time, right?
Absolutely.
Yeah.
Yeah. I mean, and for 10 years I have.
Right.
Right. And the right investor will give you insights into your own game that you wouldn't have. I mean, it's literally like having a coach. This is like zero downside. I always thought this was a very weird piece of advice out of Y Combinator to sort of try to neuter the investors. It was almost adversarial.
Right.
No controls, no information. Like literally I had Y Combinator founders during a certain era. I think it's changed a bit since Sam's been in charge, where he's a little less anti-investor. Where I feel Paul was very much, I think he maybe had gotten screwed earlier on with investors, and he was kind of like, just put the investors in a corner,
right?
Because they're going to screw your company up, which they can, right? I mean,
sure.
That whole cohort was like, we're not giving information rights. I'm like, well, how much revenue do you have and how much months of runway will this be? And we can't tell you. I'm like, but you want me to invest? Like, no, we want you to lead the round. I'm like, wait a second. I literally left. I was like, how am I going to be your lead investor without information rights? And they're like, well, we were told we shouldn't have it. I'm like, by who? And
do you really want somebody who's going to be asking questions about your business and making suggestions to do that in the absence of any data about your business? It doesn't really line up.
It's like, I'd like you to fly the plane, but we're going to put a piece of cardboard over the instrument panel. Good luck. You can look out the windshield. You get a general idea what's going on, but you don't really need to see the altitude sensor. Let's go through some of the amazing companies in your portfolio. The Skim, which is close to my heart.
Yes.
I love the Skim.
We love
what
the
a
Skim
great
too.
product.
Yeah.
How did you find the Skim? Because you were the first investor, I believe, right?
Yeah, for
How did you source this deal? What a great company. Explain what it is and how you sourced it.
The Skim is a information service to help primarily millennial women be smarter about the world. The first product was a daily email newsletter, which I know you appreciate.
Yes.
That summarizes the day's news and links to sources, primary sources for that news. And I think the latest public information is that it's got 6 million subscribers.
Unbelievable.
The vast
Rarely
majority
been
of
done.
whom open it every single day.
Yeah.
And so we found that company almost 4.5 years ago now, when it was Carly and Danielle, the two founders who came out of NBC News, 70,000 subscribers on MailChimp and a WordPress blog. And
they bootstrapped it.
They bootstrapped it. We were introduced to them by an executive at a media company, research analyst that we knew, who had become friendly with them and really enjoyed the newsletter. And what stood out about it were first and foremost Carla and Danielle, who I don't know if you've met.
I've talked to them on the phone.
Okay.
And I know of them.
Yeah.
I knew they were doing great when somebody started criticizing the fact that they were making jokes in the news.
Yeah.
And I was like, God forbid somebody has an editorial voice. And they're like, but they were being cavalier and joking about something. I was like, what? Like, this is your criticism of them? Like, they're making the news entertaining and making more than 50% of people open the email. This is a strength.
I mean, they're the perfect example of missionary founders, right? They came out of the news business.
Yeah.
And the reason they started the Skim is they kind of arrived at the point of view that the news business is broken. It's not accessible to people like us who are working women on the go, who really want to know about the world, but we're just inundated by all this information in all these various forms, and we can't keep up with it. So they created the Skim. they are dynamos. And so first and foremost, we got excited about the two of them and the mission that they had in mind. Secondly, it was 70,000 subscribers, but it was growing 100% a month and with over 50% daily open rate. And newsletters, and that kind of data just doesn't exist in the newsletter world.
No.
And thirdly, they had a vision for much more than a newsletter, and this idea that we joked about at the time that they could be the Oprah for this generation of
and sure
millennials.
enough, Oprah's a fan of it, and she had them on the show, right?
Right, exactly. So that was the bet that we made back then, and every day we're thankful that we made that bet.
One of the things I love about that story is, people say like, oh, greatness is, small traction and, high quality is not enough. And it's like, kind of is. And I notice founders, this trend where maybe you notice it as well, they are almost like ashamed of their modest growth in the beginning. And I'm almost like, do you realize that modest growth in the beginning means you put a product into the world?
Yeah, that people care about.
That people care about.
Yeah.
That's what we're in the business of finding.
Exactly.
Is if you find that little trickle of oil, we know, having done this so many times, and that could be just ginormous amounts of oil under the surface.
Getting to 0 to 1 is hard.
Yeah.
So if you have any sense that you're getting to 1, like that's something to be excited about.
And look, you probably said when you made that investment 5 years ago, if this went 100x, it'd be a real business.
Yeah.
And you said 70 and 6 million.
Right.
So it is literally 90x or 100x. It's all intents and purposes 100x.
Yeah.
Since you invested, is it a real business? No, it's a real business.
It's a real business. Yeah.
Very much a real business. Yeah.
Yeah. 8 figures of revenue, growing like a weed. It's amazing. And I'll give Carly and Danielle credit. From the very beginning, they said this is going to be more than a newsletter. And now it's got a subscription app. It's got commerce revenue streams. It's got all these different things.
Yeah.
So, that's what we're looking for is founders who have a narrow near-term focus, but a broad long-term vision and an idea of the path to get there.
AngelList, you guys are investors in AngelList or advisors?
We're angel investors in AngelList from before when we started Homebrew.
Wow.
Yeah.
So when you met them, this is pre them having even syndicates in the platform.
Yes. This was just, we know Naval, and that's how we got involved.
And that's turned out to be a good investment. What do you think the long-term business model is there? Because I know they're doing jobs as like the recruiting piece. I hear that's printing money.
Yeah.
Or doing well. Do you think there's enough of a living there to take a percentage of the carry on the deals?
I don't know.
Yeah. Hard to know.
I don't know. I mean, the original notion of kind of democratizing access to the type of investing we do is a powerful one.
Yeah. It's worked.
It's largely worked. I think it's gotten more concentrated over time. And like, you're very successful using that platform.
I was. Yeah, I left it.
But you left it. And I think that might be the problem, is the people who are most successful using it may leave it.
It's sort of like a farm league in a way. And, once you get your training wheels on, you know how to do it.
Right.
So you don't need the platform. I think when we left the platform, we had 900 or 1,000 people in the syndicate. Then we had about 1,100. Then the book came out and went to 2,000. So I try not to talk too much about what people perceive as a breakup. It wasn't really a breakup. It was, I kind of was like,
you graduated.
I kind of graduated. As a nice way to say it. And I was like, well, if you want to keep me on the platform, I want to be on the homepage. Yeah. And I was like, well, we can't have you on the homepage and not everybody else. I was like, well, I'm Kevin Durant. I need to be on the homepage. What's going on here? It's like, we don't really do it that way.
But the jobs piece of what they've done is incredibly powerful.
People are having great success from it.
Absolutely. Our almost all our portfolios post their jobs there.
Yeah.
Portfolio companies post their jobs.
What's really great about it is if you're looking for people who believe in startups and the startup ethos of building something and people having equity compensation, that's who's on AngelList. So they're fully bought in to the concept of having equity in a company as part of their compensation package. So, and they're actively looking for something that they think will be the next Uber, Airbnb, Google, or Facebook, or Twitter. Wealthfront, we're both in that.
Yep.
What an amazing product.
Incredible product. Incredible CEO and founder.
Yeah, and he's amazing.
Yeah, and a huge, expansive vision. And they're just getting started.
It is amazing how many new products they've launched recently.
Yeah.
You can do margin loans now against your money, which I've been using. It's incredible.
I think they launched a 529 product.
529 for education. Yeah. I mean, and you don't ever have to talk to a money manager. When you think about just that basic premise of not having to talk to a human being and having the algorithm and
Yeah, the rebalancing, the tax loss harvesting.
tax
It's
loss
amazing.
harvesting, and you never have to have a money manager, and they do it for, I don't know, a quarter of the price.
Right, very
25
small fee,
bips or
relatively
50
speaking.
bips?
50 bips, I think.
50 bips
Yeah.
instead of 1.25 or whatever. For you, when you look at your portfolio, what company well, it's hard to pick favorites here, but which company has gone on to have the most demonstrable follow-on funding? Because that's going to be largest amount follow-on funding or the largest number of rounds. That's something that's objective I can ask you without you having to pick a favorite child.
It's either Honor or Managed by Q. I'm not sure which has raised
Tell
the
us about
most
each.
capital.
Yeah.
Honor is a business that is trying to fix the broken elder care industry.
Yes, this is Seth
Sternberg.
Seth
Yes.
Sternberg, who did
Yes.
Meebo.
Exactly right.
Great founder.
Amazing founder.
Yeah.
And so if you're familiar at all with the elder care industry, the home care industry in particular, it suffers from a number of problems. Some of the most acute are, one, the providers of care have terrible working conditions in terms of the wages, in terms of benefits, in terms of scheduling, all these kinds of things. So turnover in that industry is something on the order of 30-40% a year.
Not dissimilar to cab drivers.
Right. And then on the flip side, the patients who tend to be the elderly and their children, who tend to be the people who are paying, have virtually no visibility into the quality of care and have a very hard time finding care providers who match the specific needs of the patient. The patient might be overweight, might have cancer, might be allergic to cats, might only speak Spanish. Like all these things are really difficult to match up with the right care provider. So Seth is leveraging technology to build a business that provides incredible working conditions for the care provider and incredible amounts of transparency, trust, and a high degree of quality to the parent and the child. So a business that we're incredibly excited about, not just because it can be valuable, but because it can be important.
Yeah, and it's a hard business. It's operationally complex. So it's going to be hard to figure out. But if you do figure it out in the way that Airbnb figured out renting your extra bedroom and homes, if you do figure it out, quite defensible.
Yes.
And now what was the other one you mentioned?
Managed by Q.
Yeah, what is this?
So Managed by Q is a New York-based company. And what they do is they believe in the same way that you can outsource your IT infrastructure or outsource accounting, you should be able to effectively outsource the management of your physical office space. And so they have built a first-party and third-party platform for satisfying all the needs that you might have in your office, everything from janitorial to catering to security to IT, etc. And
we work in a box?
We work in a box. Without the community aspects of WeWork, but all of the services that you need to manage your space.
I think this is an amazing idea.
Yeah.
How's it going?
It's incredibly well.
It's really interesting because if you think about what WeWork means to people, it's I can get office as a service, no commitment, and I don't have to deal with all this other stuff.
Right.
And so what's the big impediment to getting an office? It's having to do all that work and not be focused on your core business.
Right.
You literally have the CEO trying to figure out who's going to clean the place.
Yeah, none of that is strategic to the company, right? So
Zero.
you should be able to outsource it.
Right. But it does matter to the quality of the life of people who are there, so it has to be exceptional in outsourcing to this work. But then you look at the leak in WeWork's game. I found the leak there, which is once you hit about 7 or 8 or 9 or 10 people, you start looking and say, wow, we're really crammed in here like sardines. We have no culture that we can do in our own space. And what are we paying again? Oh, it's 500 a desk? No, it's more like 700 a desk. 700 desk is 7,000. Oh, well, the new This Week in Startup studio that I got here, and I bought the place, but the mortgage payment's probably $7,000 a month. So essentially, I can own a building or I can own a loft and have 10 times the space and own it rather than doing WeWork because they've marked it up so much. So once you're past 4 or 5 people, it gets challenging, those spaces.
You should use Managed by Q here.
Actually, it's interesting that you bring that up. We literally have been going through, what are we going to do for cleaning? What are we going to do for this? What are we going to do for that? And would be interesting if I've been thinking people should do WeWork in a box where they take Managed by Q and combine it with real estate brokers, not real estate brokers, real estate owners, the buildings, who are now have a real existential threat and crisis with WeWork and other co-working spaces, and say, we'll set up the WeWork in a box in your space.
Stay tuned.
Stay tuned, yeah. Because if I owned a building and I'm like, who's going to take this floor? And it's like, oh, I don't know. They're all in WeWork. It's like WeWork's got a waiting list in San Francisco in some places, I think.
Yeah, I think that's right.
And it's like, oh, well, why don't we just create an alternative to WeWork? I mean, it's obviously where the direction is going. Hey, when you're doing this early stage, do you care about the total addressable market? This seems to be something I hear people screaming in their pitches at demo days, like the total addressable market is this. And I always just look at it and go, well, what does that number even mean?
Yeah.
When you hear, it seems to me to be a mistake to be screaming about some TAM that you found on the internet. Do you care about TAM?
No, I'd say there's two things, which both, the answer is no, we don't care about TAM. And there's two reasons why. One is we try to focus on markets where the market is being created for the first time. So we really like to see that.
Yeah.
In cases where that's not the case, what we're trying to ascertain is whether the pain that's being addressed is large, meaning felt by a lot of people. Is it acute, meaning is it one of the top 3 pains that they're dealing with? And is it valuable, meaning can you extract some kind of rent at some point in the future for addressing that pain? If we think if we have those 3 things, then eventually you will have a big and important market. But that doesn't mean that there's $1 billion being spent here today or something like that.
Yeah, and if you look at Airbnb, it turns out there are more Airbnbs in some city than hotel rooms.
Right.
And hotels have been doing pretty well.
Yep.
So something has happened here where the amount of consumption has increased greatly. People are spending nights out more often or renting rooms more often.
Yeah, I would argue they've grown the market for both supply and demand.
Right.
Right.
Yeah, the demand is higher now. People take longer vacations because they have more options that are more affordable.
Exactly.
And so it increases the desire, the market size. So the TAM would never address that.
Right. And for the homeowner, it's unlocked an underutilized asset and turned into money.
Which is incredible when you think about it. Literally, there are people who are renting their cars 10 days a month and paying their car payment. They get the car for free. If you're willing to deal with, putting it on GetAround or other fine services. And, it's a little bit of work, but it is interesting how it is allowed people to live in cities or allowed people to own homes who couldn't have.
Yeah. And we're investors in a company called Pillow. And they work with property owners who want to take long-term rentals and give those tenants the option of doing short-term rentals within the context of their long-term lease. And what they find is tenants are willing to pay a premium on rent in order to get that flexibility because it allows them to turn around and monetize their apartment and offset that increase and make some money.
So they negotiate that tension.
Right, exactly.
Because there's a tension between sometimes the people who are renting.
Right.
And the renters
so
who
they
want
work with the landlord so
sublet.
that the tenant has the landlord's blessing.
Yeah.
And then the landlord's happy because all the services and listing and all that get managed by Airbnb in a professional way.
Right.
And the tenant loves that too because they just turn that into money.
Right. It's been a big thing in New York where people were like literally evicted because they were renting their apartments illegally. And they're like, yeah, I never rented it.
Right.
And then the landlord's like, except here's a video, supercut of zillions of people, renting your apartment. Now, did you work at YouTube as well, or you just worked
on AdSense? I worked at Google.
Yeah.
And then after Google acquired YouTube is when Hunter moved over to YouTube. But I stayed at Google before I left.
Got it. When you look at these big companies, one theory that's going around is it's the end of the startup because the big companies are so good at copying the small companies. Obviously, you don't see Google doing it all that often, but boy, do you see Facebook doing it. Is it disheartening for you when you see Facebook just copy, I forgot what the name was of the video app or something.
Oh, House Party?
House Party, and then Snapchat, like copying every feature that they come up with across all 4 product lines at Facebook. Is that disheartening for you that there is this kind of marauding approach to copying startups? And does it hurt the ecosystem ultimately, or is it just more of the same?
It's not disheartening for us because we think innovation is happening in so many different areas that if you're an investor and you can't find places to allocate capital where there's likely to be long-term differentiation, then you're not working hard enough. We tend not to do a lot of consumer social because it is hard to build defensibility there.
Yeah. Today, especially.
Yeah. But we have investments in agriculture and financial services and aerospace and healthcare and all these areas that are undergoing rapid transformation, and we're trying to hit them where they ain't.
Yeah.
Right? And if you're competing in a space that might be impacted by FANG, then you better have a really good point of view around how you build defensibility and a moat. And I think you can do that in certain areas, but you've got to be thoughtful about it.
And if you look of this last generation of decacorns, SpaceX, Tesla, Airbnb, Uber, Lyft, that entire cohort, they're things in transportation and housing and, there's so many other spaces too, construction.
Yeah, we were investors in Cruise, which obviously was a great outcome. And I think we have 4 other autonomy-related investments outside of transportation.
Right.
One of the most interesting ones is a company called Shield. And they build autonomous drones that can navigate inside buildings fully autonomously.
Inside buildings.
And they focus on selling to the public sector. So they sell to DOD, Homeland Security, Department of Forestry, all for intelligence gathering and protecting people in the field.
Wow.
And it's incredibly powerful technology and a mission of helping save lives.
So somebody could be literally on the battlefield and a drone could zip, zip, zip and 3D model or videotape the space.
Yep.
And the Navy SEALs are still doing their thing, but the drones are just...
The company was started by an ex-Navy SEAL.
Was it really?
Yeah.
And it's called Shield.
Shield.
See, this is the thing I think is super interesting about drones. People underestimate it is like there are going to be one of the interesting and encouraging things about technology is when this enabling technology comes out, all of a sudden you start to see applications that, a Navy SEAL looks at a drone and says, oh, I can see over the hill and know how many people I'm fighting.
That's right.
And then the construction worker at the Apple campus goes, oh, I can see the progress if I do this every day and then superimpose it on top of a blueprint. And that was that Skycatch company.
Right.
Like everybody looks at the tool and goes, oh, I have another idea.
Yeah, exactly right. And, talk about experiencing the pain firsthand, right?
Yeah.
Navy SEAL did tours of duty in Afghanistan and Iraq. His brother happens to be an engineer at MIT. So they got together and start this incredibly powerful company, which we did the seed in, and then Andreessen did the A.
I'd like to see those. See, I think I don't want to make sure this doesn't come across as callous, but when you see, and I don't want people to think, I think just because I'm in technology that we can solve every problem in the world, but when you see cops shooting people, there was just one where a drunk couple came around a corner in a hotel. This guy shoots the guy like on the ground while he's he's obeying his instructions, and this guy's like, I'm going to shoot you. I'm going to kill you if you don't do exactly what I said. And the kid's like, I'm drunk. Please don't shoot me. And he's like...
This is in Arizona, yeah.
He just kills him. And you're just like, what the is happening? And I just thought, why haven't we spent any resources on non-lethal weapons? Or maybe we have, but it doesn't seem like we've got them to the field yet. Why do they have to have lethal bullets that destroy a human body when we could create bullets that incapacitate? And we have stun guns, obviously, but there has to be some better solution. I mean, obviously, training police officers is the most important, and it seems like we lost our way there. We militarized the police, but non-lethal weapons would be so much better.
Yeah, I mean, I think we're moving in that direction, right? Body cameras was a next step.
Yeah.
At least now we know it's happening.
Right. The Arizona one,
right?
I think, is just sort of a turning point in policing where it's like, this guy... Yeah, if it wasn't for the body cam, we'd be like...
Right. So now that there's awareness, I think we'll start to see over the next few years innovation that will lead to solutions like you described.
Would you invest in a weapon company, like a non-lethal weapon company?
A non-lethal weapon company? Potentially.
Yeah.
Yeah.
Somebody's got to work on this. Like, why isn't there a device other than the stun gun, which we know has its limitations, but there should be one that I guess they have rubber bullets that they use in some circumstances. They don't stop people, but we seem to have just... It's so black and white. Either we're just going to destroy a human body with huge amounts of metal, or not. It doesn't make sense to me.
Somehow we refuse to learn from other countries and how they approach these problems, but maybe that will change.
I mean, if you think about politics and how broken society is one of the things that I think you probably get some pleasure from in this job that we share is we can solve problems that governments now are just so paralyzed and polarized. There's no hope that government can be functional in our country. Is so dysfunctional that it feels like it's such a huge opportunity for entrepreneurs to come in and save the world, literally. Like what Elon's doing with cars, what Airbnb and other people are doing, like with housing, or I'm working on a housing company right now, Blockable, to try to figure out, is there a way for us to make more housing?
Modular housing, right?
Yeah, like if there's so much land in this country, and the problem is the cost of housing, what if we made the houses by robots in a factory, and it was $150 or $250 a square foot, and we could build 100 of them in the East Bay, and instead of having robots and policing of homeless people in tents, just give them a home?
Yeah, but that's only half the problem, unfortunately, right? The other half is regulatory.
Yeah. It's brutal.
Yeah.
It's brutal. Do you decide not to invest in high regulatory spaces?
No. We're not afraid of high regulatory spaces. We have investments in healthcare and in public sector efforts. What we like to see is founders who have not a disregard for the regulations, but a knowledge of the regulations and a focus on educating regulators around why what they're doing maybe pushes the bounds, but should be acceptable.
And that is the key. You can push the boundary, but you don't want to ever seem like you're breaking it. Bending is one thing, breaking is another.
Yeah, this is not an area where you can, move fast and break things.
Yeah, building a social network, move fast and break things. What's the worst that could happen?
Right.
I mean, the Russians could throw our election.
At Google, we used to say it was a culture where you could, take action, apologize after the fact. You can't do that in some of these markets.
Yeah, it doesn't seem like it. It doesn't seem like a wise move for a founder. Okay, Satya Patel, thank you so much for coming on the program. Homebrew.co, after the Homebrew Computing Club.
Yes.
Homage to the 70s.
We're all standing on the shoulders of giants.
Absolutely. And you can follow Satya on the Twitter, SATYAP. But you're not super involved on the Twitter. A little bit?
Oh, not compared to my partner, but...
Hunter's Addicted.
I was VP of product there. I do love the product, and I do spend time on it, yeah.
What do you think of what it's become? I'm curious as we wrap
That's
up.
a different podcast, Jason.
Different podcast? Yeah. It feels like has this like natural audience, and I don't know, the anonymity piece I feel like it's collapsed under the anonymity and the bots and the...
I believe there's something of value on Twitter for every single person on the planet. Whether they can deliver a product that surfaces that information and makes it easy to consume is the challenge.
Got it. Right. They don't do the auto magical thing so well at this point. All right. Thanks again to our partners and sponsors and everybody who supports the podcast. And thank you, Emmy Award-winning producer Jackie and director Jacob. Welcome back to the team. All right. We'll see you all next time. Bye-bye.